Look, on October 16th, regional bank stocks got absolutely hammered. The KRE banking ETF dropped 6% in a single day, and everyone started whispering about Silicon Valley Bank all over again. So naturally, the question on everyone's mind is, are we staring down another banking crisis? Alright, if you're short on time, or you're not ready to trust some random guy on the internet, fair enough, I get it. Here's what you need to know right now. This sell-off was driven by credit quality fears, not a liquidity crisis. That's a massive difference. The S&P 500 only dropped 0.7%, which honestly is well within the normal chop we've been seeing between 650 and 670. I covered why that range matters in my last video, so I'm not going to rehash it here. Bottom line, this looks like a sector-specific scare, not a systemic meltdown yet. Hey everyone, I'm DataCat. For those of you who are new here, welcome. I spent years as an analyst inside a Fortune 50 company, crunching numbers, building models, and slowly losing my soul after 4 cups of coffee. Eventually, I traded the corporate grind for lasers and keyboards, and now I make videos breaking down markets and stocks. I'm about 3 months into this YouTube thing, so if you find this helpful, I'd really appreciate it if you hit that subscribe button and drop a like. It genuinely helps the channel grow, and it tells me I'm not just talking to myself here. Alright, so let me set the scene for you. On Thursday, markets open, and within hours, regional bank stocks are getting absolutely destroyed. The SPDR S&P Regional Banking ETF, ticker KRE, closed down roughly 6%. Every single constituent except one was in the red. Zions Bank Corporation dropped 12 to 13% intraday. Western Alliance fell 10 to 11%. Even the big boys weren't immune. JP Morgan slid 2%, Bank of America dropped 3.5%. Now here's where it gets a little messy. The catalyst wasn't some grand systemic revelation. It was pretty specific. Zions disclosed a $50 million charge-off tied to loans at its California Bank and Trust unit. Western Alliance said a borrower had committed fraud on related loans. Both were linked to funds investing in distressed commercial real estate. And that's when the market did what it always does when it smells blood. It sold first and asked questions later. Now, why the extreme fear? The fear wasn't just about those 2 banks. It was about what else might be lurking. Commercial real estate has been a known problem for a while now. Office vacancies are high, property values are down, and refinancing is brutal in this rate environment. So when you get a fraud disclosure and a charge-off in the same breath, investors start wondering, how many other banks are sitting on bad CRE loans they haven't disclosed yet? How deep does this go? And that's the thing about credit quality scares, they spread like wildfire. Alternative asset managers got hit too. Jefferies, Apollo, BlackRock, Ares, all down. Why? Because if banks are taking losses on distressed CRE loans, and those loans were packaged or financed by private credit funds, then maybe those funds have problems too. It's a web, and once one thread snaps, everyone starts tugging on the others. But this was not a liquidity crisis, at least not yet. There were no reports of deposit runs, no emergency Fed facilities, no FDIC takeovers. The losses disclosed were in the tens of millions, not billions. The broader market? The S&P 500 dropped 0.7%. The Dow fell 0.6%. That's a bad day, sure, but it's not chaos. Then here we go. The elephant in the room. Silicon Valley Bank. Because the moment regional banks start tanking, everyone's mind goes straight back to March 2023. So, what are the parallels? First, the psychology. When a new credit risk headline hits, investors in regional banks panic. They sell first, ask questions later. That's exactly what happened with SVB, and it's exactly what happened on October 16th. The KRE ETF underperforms the broader financials index, ticker XLF, whenever confidence gets shaken. That divergence was a hallmark of the SVB crisis, and we saw it again here. But here's where the similarities end, and the differences become really, really important. Silicon Valley Bank collapsed because of a liquidity and asset liability mismatch. They had a ton of long-duration securities, bonds mostly, that had lost value as interest rates spiked. When depositors started pulling their money out, SVB had to sell those bonds at a loss to meet withdrawals. That created a death spiral. Losses eroded capital, more depositors panicked, more withdrawals, more forced sales. Within days, the bank was insolvent. Signature Bank failed. First Republic followed. The Fed had to step in with emergency backstops. October 16th, totally different animal. The primary risk channel here was credit quality, specifically potential fraud and bad loans in commercial real estate. It wasn't about deposit flight or unrealized losses on securities. It was about, hey, these loans went bad, are there more? That's a slower burning problem. It's serious, don't get me wrong, but it doesn't have the same explosive systemic risk as a liquidity crisis. Let's talk numbers. SVB was a multi-billion-dollar balance sheet disaster. October 16th involved tens of millions in disclosed charge-offs. Bloomberg specifically noted, tens of millions, not billions. That's material for the banks involved, but it's not systemically large. So to be clear, October 16th looked like a sharp confidence shock centered on credit quality, especially in commercial real estate and private credit. It was not a funding or liquidity spiral. The scale and breadth were meaningfully smaller than the SVB crisis. Period. Now, does that mean we're out of the woods? Not necessarily. Jamie Dimon, CEO of JP Morgan, has this great line, "There's never just one cockroach." What he means is, when you find one problem, there are usually more hiding. And that's what the market is worried about. If Zions and Western Alliance have bad CRE loans, who else does? If there's fraud in one fund, are there more? That's the fear driving the sell-off. Alright, finally, let's talk about SoFi, because SoFi got caught in the crossfire on October 16th, dropping 5.1% to close at $26.60. And if you're holding SoFi stock, you're probably wondering why. SoFi isn't a regional bank. It's a fintech. It doesn't have a big commercial real estate loan book. So what gives? Here's the thing. When investors rotate out of credit risk, fintech lenders with unsecured consumer exposure often get hit first, even when there's no company-specific bad news. The market sees credit quality concerns and banks selling off, and it just dumps anything that touches lending. SoFi has a personal loan business, so it got lumped in. But there was no SoFi-specific disclosure on October 16th. No fraud, no charge-offs, no guidance cut. The driver was pure sector sentiment. And honestly, this isn't new. Earlier in this year, SoFi sold off during broader lender sell-offs tied to recession fears, even though its fundamentals were fine. So, is SoFi actually in trouble? Let's look at the evidence. First, the technical picture. SoFi closed at $26.60, which is still 50% above its 200-day SMA. The Golden Cross has been active for 85 days. That's a long-term uptrend, and it's still intact. It's trading near the Fibonacci retracement level at $26.52, which is a key support zone. The RSI dropped from 56 to 48. That's neutral, not oversold. And the trading pattern on October 16th was a gap and fade, which usually suggests panic selling, not conviction. In other words, this looks like sector contagion, not SoFi-specific deterioration. Now, what do we need to watch to confirm that? SoFi's Q3 earnings, which are coming up in late October. This is where SoFi can differentiate itself from regional banks. Here's what I'm looking for. 1. Net charge-offs and delinquency trends in unsecured personal loans. If SoFi's credit quality is stable or improving while regional banks are taking losses, that's a huge positive. 2. Provision for credit losses versus loan growth. Are they setting aside more money for potential defaults? If not, that suggests confidence in their underwriting. 3. Funding mix and cost of funds. I could not stress enough, SoFi has a bank charter, which means it can gather deposits and fund loans more cheaply than non-bank fintechs. If deposit growth is strong and funding costs are stable, that's a competitive advantage. 4. Guidance language on underwriting tightness and macro loss assumptions. Are they tightening credit standards? Are they expecting a recession? The tone here matters. 5. Any spillovers to its tech platforms. These are SoFi's B2B businesses providing banking infrastructure to other fintechs. If SoFi's clients are under stress, that could hurt revenue. Right now, the early signals from the headlines haven't suggested enough proof that would turn this sector-specific scare into something bigger. To be clear, I'm not saying it wouldn't, just saying it's too early to make conclusions. The broader market is choppy, sure, but it's within the range we've been tracking. The S&P 500 is bouncing between 650 and 670, which is exactly what I talked about in my last video. That's not a crisis signal, that's just volatility. For SoFi specifically, here's what I'm watching. Support level, 2647 to 2660. That's where SoFi is trading now, and it's a key Fibonacci support zone. If it holds, a bounce is likely. If it breaks, we could retest $24 to $25. Earnings, late October. If SoFi shows stable credit metrics and reaffirms guidance, I'd expect a recovery to 28 to 28.50 in the short term. That's a 5 to 7% upside. Macro catalysts. If recession fears ease and the Fed cuts rates again later this month, that benefits SoFi's lending margins. And if SoFi proves its underwriting is superior to regional banks, we could see multiple expansion, meaning the stock re-rates higher. Now, let's be honest about the risks. What could prevent a recovery? Quite simple. 1. Q3 earnings show rising delinquencies in the personal loan book. That would validate the market's credit quality fears. 2. Guidance cut due to tightening credit standards. If SoFi is pulling back on lending, that hurts growth. 3. Broader recession confirmation. If the economy tips into recession, consumer credit deteriorates across the board. 4. A technical breakdown. If SoFi breaks below 2480, that's a key support level, and it would signal further downside. My base case is that SoFi recovers most of the October 16th drop within 2 to 3 weeks, assuming earnings show stable credit metrics and management reaffirms guidance. Bull case, maybe less likely, is full recovery plus new highs if SoFi demonstrates a clear credit quality advantage over regional banks. In simple terms, for now, I'm watching the 2650 support level. Hold that, and I'd expect a bounce. Break it, and we retest 24 to 25. As for the broader banking sector, the one cockroach fear is real. If more banks start disclosing bad loans, especially in commercial real estate or private credit, this could get worse. But right now, the evidence doesn't support a systemic crisis. It supports a sector-specific credit quality scare. And look, again, I'm not here to tell you everything is fine and you should just ignore this. Credit quality matters. Commercial real estate is a real problem, but context matters too. This isn't March 2023. The scale is smaller, the risk channel is different, and the policy response isn't needed yet. If you own SoFi, watch earnings. If you're thinking about buying, 25 to 26.50 is a reasonable entry if you believe in the long-term story. If you're in regional banks, maybe take a hard look at their CRE exposure. And if you're just trying to make sense of the headlines, remember, fear spreads faster than facts. Always check the numbers. Alright, that's it for today. If you found this breakdown helpful, please hit that like button and subscribe. I'm still pretty new to this whole YouTube thing, about 3 months in, and your support genuinely makes a difference. Drop a comment if you have questions, or if there's a stock or topic you want me to cover next. I read every single one. Thanks for watching. I'll see you in the next one. DataCat out. Stay safe and stay sharp out there.